Real estate or stocks? It's one of the greatest debates in personal finance. And today, we settle it all, once and for all. Which asset classes create more millionaires? Which is safer? Which offers superior cash flow, tax benefits, and long-term returns? This isn't just talk. This is backed by hard data, historical records, and insights from the real strategies of the world's most successful investors. Buckle up, because we're going deep. Let's define the battleground. Before diving into performance and strategy, we must understand the different methods of investing in each asset class. Real estate investing includes rental properties, residential and multifamily. These involve purchasing single-family homes, duplexes, or large apartment complexes and renting them out. Residential real estate is often the first step for new investors due to its relatively low barrier to entry. Multifamily units, meanwhile, offer better resilience because multiple income streams means one vacancy doesn't cripple your cash flow. Commercial real estate. This includes properties like office buildings, industrial warehouses, medical facilities, and retail centers. Commercial leases are typically long-term, often 5 to 20 years, and can include triple net leases, where the tenant covers taxes, insurance, and maintenance. This creates a truly passive income stream, but the upfront capital requirements and potential for market shifts are significant. REITs, Real Estate Investment Trusts. REITs allow you to invest in portfolios of real estate assets without owning physical property. Publicly traded REITs are high liquid and pay high dividends due to regulatory requirements that 90% of income must be distributed to shareholders. They offer a hybrid between the cash flow benefits of real estate and the liquidity of stocks. Fix and flip properties. Investors buy under market properties, renovate them, and sell for a profit. This strategy can deliver high returns in a short-term frame, but it's risky. It requires deep market knowledge, renovation expertise, and careful timing. Economic downturns or cost overruns can turn potential profits into loss. And lastly, raw land. This undeveloped property with no structures. Investors bet on future zoning changes, infrastructure development, or urban sprawl. While raw land carries high upside, it generates no income during the hold period and may incur holding costs like property taxes and maintenance. Let's look at the stock market. Individual stocks. Buying shares of publicly traded companies such as Apple, Amazon, or Tesla offers direct ownership in a business. This approach requires intensive research and carries higher risk, but also allows for larger gains. The investor is exposed to business cycles, competition, and management decisions. ETFs and index funds. These funds track indexes like the S&P 500 or NASDAQ 100, proving instant diversification. ETFs are traded like stocks and offer low fees. Index funds, however, are ideal for long-term, hands-off investors and have historically delivered reliable returns with minimal management. Mutual funds. These funds are actively managed by professionals. Mutual funds pool capital from investors to invest in a variety of assets. They often charge higher fees, but are suitable for retirement accounts and those who prefer guidance over self-management. Dividend growth portfolios. These focus on companies that consistently raise dividend payouts, offering both passive income and capital appreciation. These stocks tend to be stable, large cap companies with strong balance sheets, making them ideal for risk-averse investors. 401k, IRA, and Roth IRA. These tax-advantaged retirement vehicles allow for compound growth with significant tax savings. Traditional accounts defer taxes until withdrawal, while Roth versions allow for tax-free withdrawals after retirement. Contributions are often automated, making them key for long-term wealth accumulation. Let's look at the stock market's performance. Over the last century, the S&P 500 has averaged annual returns of 10 to 11% when adjusting for inflation. This equates to about 7% in real terms. This consistent long-term growth is the cornerstone of modern portfolio theory and why many financial advisors prioritize index investing. Reinvesting dividends dramatically enhances returns. For example, a $10,000 investment in the S&P 500 in 1990 would grow to over $210,000 by 2023, provided dividends were reinvested. This effect, compound interest, is often described as the eighth wonder of the world by legendary investor Albert Einstein. Real estate performance. Historically, real estate appreciates at a 3 to 5% annually after inflation. However, this excludes rental income. When you add in cash flow, tax advantages, and especially leverage, total returns can match or surpass stocks. Take a $100,000 home built with $20,000 down. With 5% appreciation over 20 years, the home is worth $265,000. That's a 625% return on the original $20,000 investment before accounting rental income or tax benefits. Leverage magnifies gains, but it also increases risk, especially during downturns when property values decline or tenants stop paying rent. Let's look at the real estate advantages. Depreciation allows you to deduct a portion of the property's value annually, even if the property is increasing in market value. Mortgage interest deduction lets you reduce taxable income by deducting interest on loans used to acquire or improve properties. 1031 exchange rules let you defer 1031 exchange rules let you defer capital gains taxes by reinvesting sales proceeds into another similar property. Let's look at the stock market advantages. Long-term capital gains are taxed at a lower rate than ordinary income, typically between 0 to 15% or 20% depending on your tax bracket. Tax advantage accounts like Roth IRAs grow tax-free. 401ks and traditional IRAs grow tax-deferred. Qualified dividends are taxed at favorable rates, especially for high earners looking to optimize after-tax returns. In terms of tax shelters, real estate offers significantly more aggressive options, especially for high-income earners and professional investors who can write off losses against other income. Rental income is one of the biggest draws of real estate. Properties in desirable areas can produce 8 to 12% cash-on-cash returns. This means if you invest $50,000, you could potentially earn $4,000 to $6,000 annually in net income. With a good property manager, the income becomes relatively passive. The investor benefits from monthly cash flow, tax advantages, principal paydowns, and appreciation, all simultaneously. Over time, rent rises with inflation further increasing income. The stock market, while many stocks pay dividends, they're typically lower than rental income. The average S&P 500 yield is 1.6 to 2%, while higher yield stocks like Dividend or Aristocrats average 2.5 to 3%. However, dividends are far more passive, no tenants, and no maintenance. Also, dividend stocks can be held in tax advantage accounts, boosting after-tax income. The trade-off is lower income in exchange for higher liquidity and no operational burdens. Let's look at the stock market risk. Markets are volatile. Stocks can lose 30 to 50% of value in short periods. However, history shows markets always Black Monday in 1987, dot-com crash in 2000, in the financial crisis of 2008, and of course the COVID crash 2020, all led to recovery and new highs. Real estate is more stable but less liquid. You can't sell a house in seconds like a stock. Vacancies, property damage, and market downturns like 2008 can wipe out gains and leave you with a loan to service. The diversification reserves and proper tenant screening mitigate real estate risk, and stocks' proper asset allocation and long-term horizons reduce volatility impacts. Let's look at what the wealthy have invested in. Warren Buffett built his fortune on stocks. Through Berkshire Hathaway, he acquires businesses with durable moats and consistent cash flow. His philosophy is to buy wonderful companies at fair prices and hold forever. Donald Bren, America's richest real estate mogul, controls over 120 million square feet of Southern California property. He didn't flip homes. He bought premium land, developed communities, and held assets through multiple cycles, compounding wealth over decades. BlackRock and Vanguard, managing over $10 trillion combined, heavily invested in both index funds and real estate assets like REITs. Institutional investors diversify because each asset class behaves differently across economic cycles. Fidelity's 2022 millionaire survey shows that 88% of millionaires own stocks and 61% own real estate. The top wealth builders use both, each playing a strategic role in their portfolio. Let's look at the safest investments. Government bonds, high-yield savings accounts, and dividend-paying blue-chip stocks provide stable, predictable income. Similarly, Class A real estate in top school districts with low crime and high demand trends tend to hold value and provide steady rents. Most profitable investment. Real estate in booming cities with population growth, infrastructure spending, and limited housing supply can produce massive returns, especially with leverage. Early stage tech stocks, biotech firms, and emerging market offer exponential upside but carry substantial downside risk. Balancing your portfolio across both safe and high upside assets ensures both stability and growth. Using tools like Monte Carlo simulations can model future risk based on historical volatility. If you're looking for passive growth, go with index funds. If you're looking for steady cash flow, invest in rentals, tax optimization, real estate wins. And if you want liquidity and ease of entry, go with stocks. Here's the optimal strategy. Start with stocks and ETFs to grow a liquid base. Use excess capital for down payments on real estate. Diversify across both to withstand economic swings and build long-term wealth. Wealth equals time plus compounding plus discipline. The earlier you start, the better. 2025 presents a uniquely complex environment for investors, with tariffs being renegotiated globally and economic uncertainty casting a long shadow. The average annual rate of return for both real estate and the stock market could see a downward pressure. The International Monetary Fund projects slower global GDP growth while consumer spending is tightening in developing markets. Investors must adjust expectations, build more resilient portfolios, and remain agile in the face of macroeconomic shifts. One key strategy for 2025 is focusing on capital preservation alongside moderate growth. Investors should consider allocating more toward assets that are historically resilient during downturns, such as dividend-paying blue-chip stocks and core real estate in stable high-demand areas. These investments may not deliver explosive gains, but they provide consistent income and tend to weather volatility better. Inflation-protected securities like TIPS, Treasury inflation-protected securities, also offer a hedge against monetary instability. Real estate investors need to be particularly mindful of local market fundamentals. In 2025, many cities will be grappling with commercial property vacancies, rising insurance costs, and regulatory shifts in zoning and rent control. Savvy real estate investors could look for undervalued suburban markets with growing jobs based on Savvy real estate investors should look for undervalued suburban markets with growing job bases and infrastructure development. Additionally, properties near logistic hubs, healthcare districts, and tech corridors are expected to outperform due to sustained demand. For stock investors, sector rotation will be critical, with tariffs potentially reshaping supply chains and international relations affecting corporate profitability. Sectors like domestic manufacturing, defense, and renewable energy could see inflows. Meanwhile, high-growth tech may face headwinds if interest rates remain elevated. Index investors should consider tilt strategies favoring value and dividend-paying components in their portfolios while maintaining broad market exposure. Ultimately, 2025 will reward disciplined, informed investors who do their homework. It's a year to prioritize liquidity, understand taxation under new fiscal policies, and stress test investment models against worst-case scenarios. Those who plan for volatility rather than ignore it will emerge stronger, having taken advantage of price dislocations and new growth opportunities. Remember, wealth is built not during the easy years, but during the uncertain ones. At the end of the day, it's not real estate versus stocks, it's real estate and stocks. Understand their unique strengths and use them to build a diversified portfolio. The smartest investors know when to grow, when to protect, and when to pivot. Smash that like button if you learned something new. Subscribe for more in-depth financial breakdowns and drop a comment. Are you team real estate or team stocks, and why?